My name is Karen Lindicum. I'm the project coordinator for Maricopa Small Business Development Center. And today we have presenting Mr. Richard Spears. He is the business analyst for the Small Business Development Center, who is in charge of capital and banking. Let's go ahead and get started. Richard, are you ready?
I am. Thank you.
Okay.
So today we're going to talk a little bit about economic stress and a process whereby you can minimize it and perhaps even overcome it, but more importantly, understand what the implications are for your cash availability, your cash balances. And with that, hopefully keep you afloat during very difficult economic times. Over the last 3 years, we've survived a pandemic. Now we're in a point where we experience a lot of economic uncertainty, higher interest rates, a lot of business transformation. And so keeping tabs on how you're doing relative to your goals and expectations has never been more important. Next slide, please. So my background's in banking. I've lent billions of dollars. I've been controller and chief financial officer. So I'm an accountant by background, and I have owned 3 small businesses. So got a little bit of experience in a number of different fields that may prove to be useful. Next slide, please. So most of you will probably roll your eyes when I say that we need to have a budget or a business plan before the year starts. The reason that's so important is if you don't know what your goal is, how are you going to keep score? Frequently, what businesses tell me is, I want you to help me prove that my business should get a loan from a bank or attract money from different investors or groups. But if you don't first agree with yourself about what your intentions are, what your expectations are, what's the point in trying to convince others? So you have to have a satisfactory result. I'm not aware of any successful business that doesn't have a plan that says by the end of 2023, our revenues or sales are going to be this, and our profits are going to be that, and we're going to have cash reserves in our owner equity account of a certain dollar amount. So that's sort of the first half of the equation. You have to have a plan that you can work towards. And if you have employees, that your employees can understand and work towards. It's important that everybody's on the same page or playing the same game. And that's where it all starts. What's most critical today with so much economic uncertainty is you can't just sit back and hope the thing happens. You have to review it. I'm of the opinion you should do it almost weekly, certainly monthly, but a 12th of the year goes by if you wait to the end of the month to have a review of how you're doing to plan. A lot has to do with the size of your business, the type of business you're in, the types of customers you have, and the cash, the availability of cash based on the services or goods that you provide. So there is no universal, one size fits all answer to how you ought to review your plan. But keep in mind, having a budget is only half the equation. It's managing to it. And I emphasize point 4 here. Everything you're going to hear today, and about the only thing you need to remember, is this is all about available cash. Stress, when we talk about economic stress, we're talking about your ability to withstand unfavorable economic events or decisions, and do you have the cash to survive those? Now, if you're fortunate like Warren Buffett and you got a few $1 billion in the bank, you can pretty much just jump off of this webinar right now because he's got enough cash to carry him for several years, even if all of the businesses he owns don't make a profit. But he's in the the minority in that regard. Most of us have to worry about being profitable every single year. That starts in item 5 with your profit and loss results. I mean, we're looking for cash profitability from your business. Most businesses we talk with produce a profit and loss sheet. I don't have any problems getting an income statement or profit and loss. Fewer of them have a balance sheet. And a lot of business cash stress and a lot of business problems result not so much or not necessarily from the profit and loss statement, but because they're not managing their balance sheet as often as they're managing their profit and loss. Part of your plan under item 7 is to make sure you have an adequate cash cushion, cash reserves, if you will. You don't want to get down to where at the end of May you have $57 in your checking account. So it's important to have some idea of what your cash cushion is and how long it will help you get through some leaner times. One of the things that I did in managing multi-billion-dollar companies is making continuous course corrections when you see stress, which is what we're talking about today, but also opportunity. If things are going better than you had planned, then ride that horse as long as you can. Continue down that course. Make adjustments to your plan to see what the impact will be. In this case, hopefully beneficial. So while the concept of economic stress tends to emphasize the negative, it can, in fact, be the opposite. I have a client who actually their business grew over 25% during the pandemic period. And they didn't need any of the pandemic funding that was out there because they didn't experience any stress or any downturn in their business. Those types of businesses are few and far between, but there is opportunity, and the model we use does allow for that. And we'll see a little bit of that in my example. Lastly, it's important to know what your checking account's going to look like all through the year, but especially later in later periods. If you come to us and say, our payroll's due in 2 weeks and we don't have enough cash to make payroll, there's not a lot we can do. There aren't many banks that are going to complete a loan application in 2 weeks' time. So if you're going to have a problem, the sooner you know about it, the better, because it gives you the time and the opportunity to make whatever course corrections there are. Next slide, please, Karen. So what are we doing when we monitor stress or test or look at where we're performing relative to our budget or our plan? We continually evaluate. And as emphasized in green, I'm not going to spend a lot of time on this slide. Are you going to end the year at least 100% of what your plan is? And what this methodology does, it quantifies what your statement's going to look like in the future, but also what your cash balance is going to be. The third point, it goes beyond a budget or a cash flow. That's what you want to happen, but you have to measure what is actually happening as the year unfolds. And what we're trying to determine is, do we have the cash resources or reserves available to sustain our ongoing operations, and for how long a period of time? Ideally, you've got enough cash on hand to get through 2 or 3 lean years. Most business people we talk to would roll their eyes when I make that suggestion. But if you're down to having cash availability that'll only get you through 30 or 45 days, you're in a much more precarious position than someone that has built their business reserves or business savings, if you will, to cover them for a much longer time period. And you continuously have to make corrective measures. Don't accept as is. To the extent you have the ability to make corrections, do so, because that's going to get you back to plan and perhaps beyond plan, or at least minimize the damage in those situations, those years when that's just not possible. And lastly, and as I said on one of the earlier slides, this is all about cash. If you funded your business with $1 million in cash and your expenses a month are $10,000, you can go several years before you have a problem. But again, most of us are not in that favorable a position. Next slide, please, Karen. So what's important to note is that stress or cash stress occurs from the profit and loss statement. We all know that. But again, fewer businesses pay that much attention to their balance sheet. And we'll see in my little hypothetical example, the impact of what balance sheet has to do with that. Now, cash stress, cash shortages, we typically think they're a part of underperforming businesses. But frankly, it happens more so. And typically there's a greater need for companies that are growing very fast, where they're basically outgrowing their size and they need both time and cash to continue that growth trajectory. The third point, a sale isn't worth anything until you've been paid for it in cash. I can think of a business that I'm aware of that after the owner paid himself a normal salary, made $35,000 in net operating income. But what's hidden on the balance sheet is his accounts receivable of over $80,000 are more than 90 days old. So he may not have realized a $35,000 profit. He may have a $45,000, $50,000 loss in the next year if he can't collect those accounts receivable. So it's important that you understand that it has to be a profitable sale and you've got to get paid for it in cash. The next thing, again, is kind of a simplistic view, but if you can't generate positive cash flow from your sales volume to at least break even, you're going to fail. You can't save your way to high performance. You can't borrow your way to high performance. Whatever business you're in, the revenue from your goods or services needs to generate positive cash profit, or it's just inevitable that there will be problems down the road. Insufficient capitalization and retained earnings, which is the same thing as your personal savings account. If you don't leave money in your business, it puts a premium on earning net cash income every single year. And a number of problems we've seen over the years is because business people take more money out than is prudent from their business. An example is if a company makes $8,000 net operating income in the month of March and the owner withdraws $8,000, okay, nothing's changed. But in the following month, if they make $6,000, but they still take $8,000 out, they just have worsened their company cash reserves and net worth by $2,000. So if you want to sustain your company during tough economic times, it's important that you build your owner's equity. We see a lot of negative owner equity companies, and it's because they've either they have insufficient profits or they've taken more out than may be prudent. So we're going to look at a hypothetical company that's experiencing stress in Q1 of the new year and look at how that can be addressed. Next slide, please, Karen. So the green rows are what the plan was, the yellow are the stress results. So these are kind of small, but basically what happened, this is a $120,000 roughly revenue company. We're going to see from the picture that it looks like we're in the restaurant or the coffee shop business, but it's about $125,000 revenue company that, makes about $25,000 a year. I'm sure they pay themselves salaries as part of their expense level, but they forecasted for the first quarter that their sales would be about $29,000. In reality, what they found is sales were down a little bit. So their revenues were basically $28,000 or a 5% decline from what they had planned. Not surprisingly, the price of coffee and food went up. So their cost of goods sold is up about 3% per month. And therefore their stress gross profits down a couple $1,000s. Now they were able, if we go down to to operating expenses. They did keep their planned expenses at plan in the month of January, but then they saw them go up 5% and 7% in the months of February and March. So their operating expense was about $240 more. The net result of that, where the big red arrow is to the left, is they earned $2,200 less than they had planned in net operating income. So here's the interesting thing. You might say, well, you know, I only missed revenues by 5%. That's not too bad. Cost of goods up a little, expenses up a little. Yeah, but what that translates to is your net operating income's 37% less. And what it also means, if this trend isn't corrected, is that you're going to have a shortfall in your checking account of just under $9,000 by the end of the year. And if you want to get caught up, if we were doing a 2 or 3 year plan, they're going to need to grow their 2024 revenue either 37 or 58%, depending on their net operating income ratio to sales, in order just to make up that $9,000, because they're $9,000 in the hole before the year starts. If there are any questions as I go along, please give them to me at any time, and I'll answer them, because I know we get a little bit here accounting-y in some of this explanation. But again, the first question I asked you, should you wait 3 months to fix this problem? If you do, again, you have a $2,200 problem. If you addressed it in January, you'd have a $680 problem. And if you were monitoring it, you know, weekly or mid-monthly, maybe you have a $170 or a $340 problem. Now, depending on the type of business, either you can make some corrections or there's not enough trend or not enough information. But, you know, there's more danger in waiting, you know, to the end of the quarter to review your results. And then another important question, and this ties to the balance sheet, can you be profitable? And in this case, instead of earning $6,100 in the first quarter, as they thought, they earned $3,863. Can they run out of cash? Yeah, if they spent more than they had in the checking account to start with, and including the addition of the $3,800 they earned on a stress basis. So we'll see how that works on the very next slide, please, Karen. So we're going to assume that top red circle with that other little red mark that I couldn't get rid of. We're going to presume they start the year with $8,800 in their checking account. Now, there's 3 parts to a cash flow statement. The first and most important is your profit and loss statement. Are you making a cash profit from running your business? Most small business people produce that profit and loss. And if they're making a cash profit, they give themselves a high five and go on to the next month. But what's equally important is what's happening on the balance sheet. How are you changing your balance sheet, and how are you financing your business? So if we look at this example, they both start out with $8,800, but if we just look at the balance sheet, or excuse me, the profit and loss, the operations part, their cash balance is 15% less than what they had planned before any balance sheet changes. And that's the difference between, you know, the difference is the difference, $2,200 based on the stress net operating income change. But let's assume, if we look at the middle of that chart, the orange circled $2,000. Well, guess what? Their computer died, and unexpectedly, they had to buy a $2,000 new laptop computer to run their business. If we look further down, we see the wider orange circle. They have loan payments to make. They could be idle loans. They could be business credit cards. It could be a term loan, could be an equipment loan for a truck. But they spent $3,000 in that quarter on that balance sheet item. So cash is now down on a stress basis 22% because of the additional balance sheet spend of $5,000. Now you see my yikes comment. If the trend continues, they'll have almost $9,000 less than planned in their checking account at year end. If they were at plan, they instead of starting the year with $8,800 as they do in 2023, they'd start 2024 with almost $18,000 in the bank, as would their retained earnings because of the being able to add that $8,900 in the bottom red to their owner's equity section. So if we look at how many months of expense coverage they have, it's less than 4. That's the 7694 next to the circle at the bottom. If you take they're spending about $2,000 a month in expenses, and if they have $7,600, obviously they only have less than 4 months worth of coverage for their operating expenses if business, continues to fall, or if they have other balance sheet items to consider. So let's go to the next slide. So getting back to plan, overcoming stress. Are there guaranteed solutions? Well, of course not. But the more you look at your plan, the more time and options you have. The most critical thing is to determine if any shortfall is a one-time event, like replacing that laptop computer for $2,000, or is it the start of a trend? And depending on what you're seeing and your evaluation of your business, it's going to determine what types of strategies and options and actions you're going to take to try and get back on plan. So let's look at some of the standard sorts of profit and loss and balance sheet options you can consider. You can increase volumes or the price of your revenue sources, raise your prices or sell more. You can reduce the cost of whatever it takes you to produce that good or provide that service. Variable expenses are those you have some control over, some discretion over. Maybe you cut your marketing budget just a tad. Maybe you cut your entertainment budget, if there are such things in this day and age. But you have the ability to change them. Can you reduce fixed expenses? Those are tougher to do, but an example might be business insurance premiums. Maybe you can get a quote from somewhere else where you can change the amount of your business insurance expense. Can you accelerate cash receipts? If you're giving your customers 90 days to pay you, you're their banker for 90 days. You're having to pay your expenses, but you're not getting reimbursed in cash, hopefully at a profit, for 90 days. Can you move it up to 30 days? Can you give them the traditional 210 net 30 discount? But what can you do to accelerate that? And are there balance sheet opportunities that can add to available cash? If you've got a piece of an equipment or a truck that's not doing anything, sell the darn thing and put the cash back in the business. Are there other equity or financing options that you can draw from? Maybe you have to put $10,000 into your business, or maybe you have to go to the bank and get a business credit card or a line of credit. So are you in a financial position to be able to draw on reserves that aren't currently in your financial statements? Next slide, please, Karen. So from this slide, a picture here, it looks like we're in the restaurant business. So we're going to see what these people did based on those numbers that we showed a couple slides back, where we're $2,300, $2,200 in short of plan after 3 months. Next slide, please. So did they just take what came, or did they do something? Well, they decided to pivot, and they started to fix things to the best they could. So in January, they realized that their sales were down, their costs were up, their operating expenses were more. They didn't wait till the end of March to the end of the quarter to fix that. So one of the things they postulated was that if they cut their sales price by 7%, they would increase their volume by 15%. So that's one fix. That's the top two column red circle thing, which are shown as negatives because we set up a stress spreadsheet based on assuming the worst, like in January where their costs went up, or excuse me, where their revenues went down $500 from $10,000 to $9,500. But in February and March, they actually are reporting more revenue, $9,600 instead of $9,000 in February, $11,000 instead of $10,000 in March. So they increased their revenues by $855. That was one fix. If we go down to cost of goods, they weren't able to completely eliminate higher costs, but they were able to cut the percentage increase from 3% to 2% in February and March. So their cost of goods was $408 higher, but it's less than it would have been had they continued at a 3% increase. Similarly, on the next item down, cash expenses, whereas in February had they left things just go as the trajectory indicated, they would have had 5% and 7% expense increases. Here they've cut them to 3% increase and 5%. Maybe they changed their marketing. Maybe they did something different that reduced the rate of increase. So while they still went up $160, the sum total of what these actions are both more net operating income and more cash. They're now over plan by $287, the green circled number. So instead of earning $6,100, which was the plan for the first quarter, they're at $6,387. So those are the types, that's why it's important to make these changes, make these analyses as quickly as practical, because you can have this kind of an impact. So it's not a super dramatic change, but they are back on plan, and they do, if it plays out this way, they will end up with $287 more in the bank than they'd planned on. And what that means is they're going to start the year 2024 with that $18,000 in their checking account, not the $8,000 that was indicated if they just let things happen to them. Next slide, please, Karen. So a little bit about liquidity. You read frequently about quick and current ratios, and basically that's the relationship between your current assets and your current liabilities. And those are typically defined as assets and liabilities that have terms of less than 1 year. Current ratio is good. It should probably usually be 3 to 1. 1 to 1 is the minimum, but that's a little easier to achieve because it includes inventory and accounts receivable. I prefer the quick ratio, or acid test as accountants call it, which is how much cash and cash equivalents do you have compared to your current liabilities. That should at least be 1 to 1, but that's a more valuable tool for business owners because it measures your highly liquid assets compared to your obligations to pay within a year. It's very difficult for you to liquidate inventory without taking a big haircut or discount, and it's hard to get your clients to pay you your accounts receivable faster than what you're currently accepting at. So you really want to always keep track of what your cash and cash equivalents are as it relates to your current liabilities. Next slide, please. Okay, we hear working capital too as another definition of what we're talking about. Well, working capital is typically expressed in dollars. And what you do is you subtract current liabilities from current assets. Obviously, you want that to be positive. But again, like the difference between the current ratio and the quick ratio, if you have inventory you have to sell at a fire sale, or if you have 90-day delinquent accounts receivable, those count towards your working capital, but they're not really helpful to your business. And so the same thing applies here when we're talking about working capital is, how much cash do we have relative to the expenses that we have to pay in cash? And there isn't any right number here or right ratio. It depends on the business you're in. Since we're in a hypothetical coffee shop or quick serve restaurant, they're getting their cash virtually the same day. People are paying in cash. They're using their credit card, so they're going to get paid the same day, next day, or maybe 2 days later. And their gift cards, which are prepaid, so that they're getting cash quickly. On the other hand, if you sell machinery or a more difficult service that where you give your clients 90 days to pay, you're their banker for 90 days. You're lending them that sales money for 90 days. So working capital is going to be different for that sort of a business, as is the ability to actually utilize it than a quick serve restaurant. So no standard answer. Again, cash is king, as I said on the very first slide. Next slide, please, Karen. So what can you do to increase your cash? Reduce or repay your non-cash short-term assets. If they pay you for your accounts receivable, you reduce inventory, that's going to cash. That's a source. If you sell long-term assets, if you're not using that old truck, sell the thing, put the money in cash. If you're not using cash because you're borrowing on item 3, increasing your short or long-term liabilities, that along with 4 is a source of cash for the business. And if you're running a profitable business, I should probably have made that number 1. Item 5, if you're running a profitable business, then your cash is going to grow. There's no two ways about it. Working capital, is a derivative of all of these things. So if it's going up, you have more cash. If it's going down, you have less cash. How do you use cash? Well, when you buy inventory, buy a long-term asset, like you buy a truck, you're going to be using your cash. If you pay back your liabilities, whether they're loans or pay yourself out of your business, you're using cash. If you're losing money in your business, cash is going down. And again, some of that ties into working capital decreasing. Next slide, please. So it's important to manage your own business. Another helpful tool is to compare your financial results, which again, take a balance sheet as well as a profit and loss statement, with people that are in the same business as you. And one of the tools we use is a resource called Profit Sense. I'm not going to spend a lot of time on these because the numbers are so small, and they don't pertain to this hypothetical company. But as you can see, we have current ratios, quick ratios, profit margins, debt to equity, a lot of ratios that show how the company's performing relative to people that are doing the same sort of business, be they in Arizona or around the country, whether their revenues are less than $1 million or over $1 million. And what this does is quickly depict items that are green, where your company is more favorable than your industry competitors, and red when you need improvement in those particular items to catch up with the industry. If they're neither red or green, they're pretty much average. So these are data and ratios. Next slide, please, Karen. So profit and loss statement, this is interesting. It shows you how your various measures compare to people in your business. So in this case, the third item down, gross profit, they're actually doing better than or actually about the same as the industry in terms of profit margin. They're 36% currently, 12 months, 29, just under 30%, and the industry's at 30%. So not a lot of difference there. And as we go down the scale here, we see that this company actually is losing money, adjusted net profit, at least for the current data, of 4%, whereas the industry's up about 13, and long-term, this company's up about 13. So it again tells you, where you can focus your attention on. Next slide, please. Same thing applies to both this slide and the next, where it's the asset mix and the liability mix. This company has very high, unusually high total current assets, 93% almost of their total assets. It's the fifth item down. So pretty much everything they have on their balance sheet is a 1-year item. Next slide, please. By comparison, their total current liabilities are 46%, the industry's at 44%. So this would tell you that their current ratio and quick ratio are pretty solid because they've got at least twice as much in current assets rather than current liabilities. Next slide. So some closing thoughts. The biggest companies in the world do all of these things we're talking about. So it kind of begs the question, why aren't small business people taking the same process that enabled these companies to become as large and theoretically profitable as they are? Free cash flow is something you see in every analyst report on anybody that's reporting, be it Ford Motor, Amazon, whomever it might be. How much cash is the business throwing off that can be used for whatever need exists? So as I highlight in green, you start each year with a plan that meets your expectations and goal. These people started the year expecting to have sales of $125,000 and make $25,000 net operating income, assuming they had some salaries as part of expenses. So that was their goal. And then they managed to that plan, hypothetically. And they managed their cash flow and their balances and cash reserves. And we saw even with a business like this, taking action would improve their cash balances at the end of 2023 going into 2024 by almost $9,000. That's significant for a business that has revenues of $120,000 and starts the year with $9,000 in their checking account. A couple other things, depending on your size. I mean, you need to make sure that your HR plan, if you show in your plan that your salaries aren't going up, but your human resources people are looking to add 5 people, that's a disconnect. If you plan on not spending any more money on fixed assets, but you need to buy 10 new trucks, that's a disconnect. Marketing and sales plans, those tend to be discretionary, but they need to fit into the overall budget or plan. The time to have your contingent loan facilities or your equity reserve facilities in place is before you need them. Not a good idea to go into the bank with your hat in hand because you need to meet payroll in 2 weeks. So try and have those in place beforehand. And don't ever forget business insurance. That's not a place to skimp, because if you have an all-risk policy, you can cover a lot of cash contingencies that otherwise you would have to fund out of your own business. So my last thought, you can do it, and we're here to help. Next slide, please, Karen. So how do we assist you? Well, we can help you get access to additional capital. We're pretty good at business planning and helping you grow your business, develop your financial understanding. We have specialists that work in sales, marketing, operations, international trade, manufacturing, and technology. We help in-business clients and brand new to the business world clients. Next slide, please. So in my group, the capital group, I mean, we can help you with your, where do you stand in being able to apply for a loan? Is your loan expectation reasonable? Do you have the loan package that's needed? Which typically is, if you're in business, 3 years of past financial data, a business plan, 3 years projections going forward, personal financial statements, tax returns in some instances, how you're going to use the money. If you're going to borrow $50,000, what specifically is the menu of things you're going to use it for? So we help with that. We help you project. I can think of a client I had that was eligible to borrow more SBA EIDL money, but she didn't because there was no way out. Her business had suffered so dramatically based on who her clients were that all she would have done if she borrowed more money was to dig a deeper hole for herself. So she passed. So we have 2 ex-bankers on staff, so we know a little bit about banking, capital, SBA loan programs. We have a big lender pool that we can refer to based on your particular need and your business type. We know who likes to lend for what types of projects. And we come up with other strategies if that, if lending isn't the bank lending or alternative lending isn't the only option. Next slide, please. So if you're not our client, you can request our no-charge counseling. We're funded by the 3 organizations you see at the bottom, the Maricopa Community College District, the ACA, the Arizona Commerce Authority, and the SBA. So we're your public link to those organizations to help you with whatever assistance we can provide and with resources we have on hand, like the Profit Sense industry comparison I showed earlier. Typically, our process is to have an initial counseling session where you explain to us what your goals and objectives are and how we can help, and then we start working through them on follow-on sessions. The way we're paid, even though it doesn't cost you any money, is tracking your business success while you're our client. So if after a year of being our client and your sales go up from, say, $125,000, like our hypothetical company, to $200,000, we're going to send you one of our standard forms that shows that you had $75,000 in revenue growth. That's what we need to track in order for the 3 funders down at the bottom of the page to continue to fund our services, because we're showing the business success that our clients are having while they are our client. Next slide, please, Karen. So that's it. Any questions? Do we have any questions or comments that are there, Karen?
We do. Ashley Jerome said, I may have missed it, but what common sources of industry numbers, or what are common sources for industry numbers for comparison?
Okay, good answer, or good question, rather. We have a number of paid sources that we pay the subscription price for, that we're able to offer our clients, offer companies that are our clients. If you wanted to use Profit Sense, for instance, on your own, there would be a fairly hefty subscription charge for you as an individual company. By being our client, typically we're able to provide that source. We have many others. We have IBIS World. We have a number of other databases that we subscribe to that we make available as appropriate to our clients. If you're our client, we can help you get, Darlene, we can help you with spreadsheets and cost sheets, absolutely. And we'll help tailor them to your particular business. So again, it starts with being our client. Again, our services are offered at no charge because we're funded by the folks at the bottom of the page. I hope they can hear me.
I think so. Any other questions?
You're welcome. So again, the whole thesis of this presentation is you have to have enough cash to run your business. And the thing that most businesses miss isn't related to their profit and loss. It's to not track what happens on their balance sheet and not keep enough savings in their business to get through the lean times. So as I say, I had a client that didn't need any pandemic money and his business profited, but it's because he was, a little bit immune to what was going on. And over the years, he hadn't taken a lot of money out of his business. Renee, thank you. If there are no more, Karen, I think we're done.
I think we're done.
All right. Thank you, everybody. Appreciate it. Any questions, you can reach out to the Maricopa SBDC and we'll be glad to help. Thanks for your time.
Thank you, everybody. Bye-bye.